Good Friday evening, everybody, and welcome to Fonti International. I'm Alexandra Georgiev, and we're going to be together for the following 1 hour and a half. As we can see, stocks are trading down ahead of the China's press conference. It's not clear at what time exactly, but President Donald Trump is going to hold a press conference, and of course, it's going to be focused on the developments in China and more specifically the crackdown in Hong Kong. I want to show you very quickly all the three major averages. S&P 500 is down by 0.4%. Dow is almost 0.8% in the red territory, and Nasdaq Composite trying to recoup some ground, as we can see, 0.03% above the flat line. Russell 2000, on the other hand, is 2.5% in the red territory. If we scroll a little bit, we can see that the FANGs are all trading in the green despite tensions between President Trump and Twitter. Twitter, on the other hand, is down by 2.20%. We're going to talk about it certainly a little bit later on the show. First of all, I want to show you very quickly the fixed income board. So far, the US 10-year Treasury is hitting 0.66, as we can see, slightly lower, the 2-year 0.15 and the 3-month 0.15. So situation in terms of fixed income is also pretty interesting. The DXY is inching lower 0.14% at the 98.33 mark. Euro dollar 1.11. As we can see, strong gains for the euro by 0.25%. Sterling also doing well today, 1.23 against the dollar, but still 0.4% lower. Let me show you very quickly also the European trading session. It's been not really positive Friday trading session for the European stocks. The pan-European stocks essentially closed down by 1.6%. But the index is still up over 3% since the start of May, on pace to register its second straight positive month following April's more than 6% gain. Once again, the German DAX 1.65% lower, CAC around 1.60 lower, and the Italian FTSE MIB was the outperformer today, down by only 0.84%, especially I'm saying outperformer because all the other European bourses traded down by more than 1.5%. So there are several stocks to watch here in Europe. Certainly one of them is Renault. A lot of things going on regarding Renault. It's gonna, axe more than 15,000 jobs. So certainly not positive news. And we're gonna talk about it in the third part of the show, where we're gonna delve deeper into the automotive sector. That's for sure. I just wanted to move very quickly back to the US and start with the macro data. In particular, consumer spending, US consumer spending fell by a record 13.6% in April during coronavirus lockdowns. But there are signs that purchasing is starting to pick up. The April decline was the steepest for records tracking back to 1959. Personal income, which includes wages, interest, and dividends, increased 10.5% in April, primarily reflecting a sharp rise in government social benefits through federal coronavirus stimulus programs. As states start to reopen businesses and Americans return to work, activity in some pockets of the economy appears to be perking up, or at least not deteriorating further after hitting rock bottom in April. So certainly it's going to be extremely interesting to see what is going to happen right now after we are far from the coronavirus shock, or at least the initial coronavirus shock. I want to talk about one of the most famous disputes, and this time it's not between the US and China, but between the President of the United States and Twitter. As I said a few seconds ago, Twitter is down by 2.30% today. Actually, Twitter shielded from public view a tweet from President Trump for breaking what the company said are its rules about glorifying violence, a step that is likely to escalate tensions between the president and the social media giant. The decision came one day after President Trump signed an executive order taking aim at what he alleged was censorship by social media companies, calling Twitter an editor with a viewpoint. Mr. Trump, in tweets posted shortly after midnight on Friday, criticized protesters clashing with police in Minneapolis over the death of George Floyd, a black man who died after a white officer pinned him to the ground with a knee to his neck. What happened in Minnesota is really shameful, and I'm really sad about it. I guess all the world is sad about it because racism is something horrible. Of course, their public reaction was huge. So President Trump tried to, calm the society, but a little bit in a weird way. So Twitter decided to flag his tweet. That's for sure. Anyway, in order to weigh in the situation, I want to bring on the show Federico Righini, Portfolio Manager, Global Capital Group. Good evening, Federico, and thank you so much for joining us.
Good evening.
I would like to start with the fact I just wanted to remind everyone that the president of the Federal Reserve is talking right now, Jay Powell. He's talking to Alan Blinder, former Fed vice chairman. So far, Powell said that the Fed is days away from making the first loans in the Main Street lending facility. I was wondering, what do you expect from the market, since we don't know at what time exactly is going to be the press conference of the White House, but certainly there is going to be a press conference and it's going to be focused on China.
Yes, well, we see what's happening today is definitely a red day across all sectors. In exactly for this reason, we see the market taking a stance and the indices going in the red exactly because they're waiting for this press conference and to try to establish what are going to be the consequences of the statement. I don't think that they will be particularly heavy, especially because let's say that the worst that can happen for investors is the classification of Hong Kong, and to see let's say to change the status of Hong Kong, and this could have an impact on the further trade. But everyone is sort of expecting that the administration cannot afford to impose at this moment further tariffs for the reason that we are going into elections, and of course the economic crisis, it's already heavy by itself. So it's not a good moment to impose new tariffs where the political agenda has a focus on the electoral campaign. So we see, however, indices being a little bit, investors being a little bit worried. We've seen a positive week overall for across all sectors. So let's say that when last night we knew that this press conference was going to be held and a statement was going to be given, there was some profit taken, some risk off in the market.
I want to talk about what is going on, of course, between President Trump and Twitter. Certainly, this is an unprecedented situation because Twitter, as far as I remember, correct me if I'm mistaken, has never censored, his, all the people who are using Twitter. So certainly this is unprecedented. I was wondering, what's your take on the situation, since it's very delicate? From one side it's censorship, from the other side it's the President of the United States who is definitely spreading fake news.
Yes, well, let's say that as many other moves taken by this administration, this move is unprecedented, not really for what is going to impose or what it looks like it's going to impose, but for the methodology that is used, because it is definitely very rare to see a president of the United States using an executive order to achieve this type of goal. Having said that, the principles that are being used to enforce this act are not completely out of scope, for the reason that let's say that all social media have always been privileged in the legal framework they've been regulated in, because they couldn't be held liable for the content that they were either posting, disseminating, or changing. Now this will change, and this pretty much is a recognition of the fact that social media are not neutral. And this is some sort of true, because social media companies have a power right now to really, and we've seen this also in the elections of 2016, to really drive public opinion. So right now, if the situation unfolds, we will see what's going to happen. It's unclear yet. But what this is going to cause is that social media will be liable for the content and information that they publish and actions that they take in order to control the information that is disseminated. in my personal opinion, at this point, it could have been the case a few years ago that social media were neutral, but at this point it's clear that they're not. So the biggest fear in this sense is that this is going to be the start of a process that will impose some regulation on social media, and that it somehow destroy or modify the business model of these companies. But it's very early to draw conclusions, and we will have to see how technically act will be enforced.
Absolutely, I agree with you. There is going to be a change in the business model of the tech giants. I know you're not covering Twitter specifically, but I was wondering what impact do you expect on the stock, because President Trump has 80 million followers. Probably he's one of the most followed people on Twitter specifically. So if he was to shut down his profile, which is not very likely scenario, but still, do you expect also any negative impact on the stock if these tensions were about to rise?
There could be short term, but I think long term the impact could, like it's Donald Trump sign off Twitter is not definitely going to be that huge. And we can see that if this is going to happen, and if some other personalities, let's say, are going to follow, and the business will, the way that social media is used is going to change radically, then this might happen. But this type of events that usually don't have this impact. It would be a different situation if the enforcement were to change the business model or the advertising framework of the company, but this doesn't seem to be the case. So I don't see this impact.
On the other hand, what about the entire sector? Because as soon as the announcement yesterday, of course, that the Trump administration is targeting the social media companies, we saw major decline for all of them. Today they're regaining some ground, but not a strong gains over there. As far as we see, Facebook, for instance, is 0.05% lower. Apple is only 0.25% in the green. Amazon also. So I was wondering, what does it mean for the entire sector, which is already targeted, but from a different point of view from European leaders?
Well, the action that we see overnight clearly was reflecting some concern, but it was very light. The markets in general were down overnight, so these companies just followed through what's happening in the broader market. Obviously, there were some extra concern regarding what is happening and what will happen, will unfold. But I don't see the market action in this group right now being reflective of this particular concern that we see today. What is very, very important for the sector is whether also the United States will start regulating it. This is one of the most unregulated sectors, and yet one of the most important sectors in the stock market. So let's say that there could be some disruption if rules are changed, and these companies will have to transform themselves. Having said that, we have seen already moves from Facebook, for example, to start entering other markets, especially if you look at Facebook, the e-commerce. So I think that regulation might pose some challenges, but eventually these companies can adapt and will survive. So I don't think a long-term effect for now.
All right, I just wanted to bring a very quick update regarding Jay Powell and, of course, his interview with Alan Blinder. The Federal Reserve Chairman Powell said the central bank's long-awaited program to lend to small and medium-sized businesses is about to get off the ground. The Main Street Lending Facility, which will target companies with up to 15,000 employees, has been difficult to set up, but is just about ready. This is what Powell told Princeton University economist and former Fed official Alan Blinder in a webinar interview that was going on until a few minutes ago. So I was wondering, so far, do you believe that the Fed has helped enough the medium and small businesses if we put aside, of course, the fiscal policy help?
It's hard to say enough because the PPP program was not really effective, especially for the small businesses. But things are changing. Everything happened very fast. I think eventually this will be reached. So like, small business will be reached. I have to say that it was definitely imperfect, but what the Federal Reserve did for the economy is something that no other economy in the world has been able to deliver. So there are definitely some deficiencies, but I think that the results for now are it's too early to determine what they're going to be. But we see already the stock market discounting what this will be. So the fiscal stimulus, which is of course possible because also the Federal Reserve is supportive. These institutions are independent from each other until it's needed. So, like, I think that the stimulus program that has been unfolded and enforced is of a massive entity. We've never seen something like this before. So, I believe the effects are going to be positive.
I just wanted to have a very quick look at the different sectors. For instance, today is a little bit of difficult day for the cyclical stocks. In particular, the financials are trading down. If you have a look at the KBE index, so far is off almost 3%. JP Morgan 2.25% in the red. Wells Fargo as well, almost 3% in the red territory, and Bank of America 1.81% in the red territory. I was wondering, we do see a major rebound of the cyclical stocks, and we all know that they are pretty dependent on the economic situation. Today we saw a little bit of betterment also yesterday with the jobless claims. They were significantly lower, but still, 2.1 million people for 1 week is not a good result, that's for sure. But how do you explain this, significant rebound of the cyclical stocks? Do you believe that it's a little bit exaggerated? Do you believe that investors should be more cautious in terms of financials and industrial stock?
I believe so, but this was part of a sector rotation. If we were looking at the stock market in the first weeks of the rebound that started in late March, everything was driven by the tech sector. And we have explained before that the tech sector, in particular the five famous stocks, Facebook, Amazon, Apple, are at this point have a record weight in the indices of about 20%, yes, if I So they were definitely helping the market rising, and they were driving the rest. After that happened, we have seen the past 2 weeks not as solid in performance for these components. Still, they were positive, but they were not as positive at the beginning of the rally, and we started seeing some sector rotation, and that's what explained the market keeping a positive performance. In particular, the banking sector and in general the financial sector that you were mentioning had was the principal component of what was driving the market higher, and this is explained by a sort of momentum happening in the equity market. And this can be explained by the fact that the market is forward-looking and at least 6 to 9 months, and that the economies around the world are reopening. So this is reflected of also in economic activity, and little by little these sectors and this stock will have to come back. It's of course early yet to determine what the economy is going to look like in a few months. But this is what's happening. So eventually, with the economic activity starting, these companies will definitely benefit from the situation. So I think that it's early right now to determine and to look at what banks are doing every day, because the situation is still very uncertain. But it was natural that had the indices, the stock indices, to keep rising. Eventually, this group had to follow through.
I was wondering, today we've heard pretty sad news, at least regarding the European automotive sector, and the automotive sector has always been a strong side, and of course income for the EU area, that's for sure. I was wondering, what is your take on the US automotive sector. I do see that all the stocks are plunging by more than 3%, or at least more than 2.5%, all the major US stocks so far. Do you foresee anything positive, and what do you advise your clients in terms of diversified portfolio?
Well, let's say that for the automotive sector, this has been for some time, both in the US and in Europe, a sector that was, let's say, finding some issues. So it has not been the best sector to position for a long time. Then, of course, when you have an economic crisis, durable goods are the first one to get an impact. So I'd say I am not very positive on the sector, given that itself it was in a good moment for the economy. It was already facing some issues, and we see many companies finding the only way to survive with massive mergers and massive consolidation. So right now, with this situation, it's hard to see how these sectors will be able to perform at the levels that we have seen the past years. Having said that, in the US and Europe, situations are completely different. This is because in the US, the market, it's consumer driven. In Europe, it's export driven. So whenever something happens, whenever there is a downturn in the economy, European manufacturers, of course, suffer way more than US manufacturers. In terms of a diversified portfolio, of course, this can be a component, but I would suggest a very small component of the portfolio, which we have seen more and more the need to find more exposure to the technology sector, which is pretty much an all-weather sector. Something that is very different than what it used to be a few years ago, but also the economy has changed. So even if you don't have anything to do, if you don't work for a tech company, you use these products, and in whatever sector you work, you use these companies, you use the services that they provide, and it's impossible to do. So these companies, even if it's hard to explain because it's hard to see how little impact they might have as compared to the market capitalization in the stock market, for example, and the components and weight components that they have. But pretty much every other sector is dependent on these sub-sectors. So technology more and more becomes a bellwether for the entire market, and not only because of the weight of the things.
All right, thank you very much, Federico Righini, Portfolio Manager, Global Capital Group. Thank you for joining us. Have a great weekend.
Thank you, you too.
Well, I want to show you a stock